Remember that chaotic trading floor scene in Trading Places where Dan Aykroyd and Eddie Murphy are shouting, papers flying and prices changing every second? In that scene, they were trading orange juice futures, basically placing bets on what the future price of orange juice would be. Or how about season 3 of HBO's Industry when Harper pitched Petra on buying natural gas futures to hedge their exposure to a risky IPO? Whether in the movies or in high-stakes TV dramas, Hollywood loves to portray futures trading as this fast-paced, high-adrenaline game of chaos. But in reality, it's much more strategic, and these days it's not happening in the noisy pits of trading floors. It's all about algorithms on sleek electronic platforms. So today, we're going to take you behind the scenes of futures contracts, what they are, why they're so important, and how you can start trading them yourself, minus all the movie drama. Let's break it down. Ever wonder how investors predict future prices and make big moves in the market before it even happens? Welcome to the fascinating world of futures contracts, where traders lock in prices today for assets delivered tomorrow. Today, we're diving into the basics of futures contracts and how you can get started trading them. Whether you're a beginner or just curious, stick around for a simple breakdown that can make this complex market a lot clearer. Let's start with the basics. What exactly is a futures contract? A futures contract is a legal agreement between two parties to buy or sell a specific asset at a predetermined price at a set date in the future. This can be anything from commodities like oil and wheat to financial assets like stock indices or currencies. The key here is that both buyer and seller agree on the price today, but the actual transaction takes place later, hence the name futures. So, why would anyone trade futures contracts instead of just buying or selling the asset directly? First, traders use futures to speculate on the price of an asset. If you believe oil prices will rise next month, you can lock in a lower price today and profit if your prediction is right. Next, futures are also great for hedging. Let's say you're a farmer worried about falling crop prices. By selling futures contracts for your crops now, you lock in a price and protect yourself from market fluctuations. Lastly, leverage is a powerful feature of futures. You only need to put down a fraction of the contract's value. This means you can control large amounts of an asset with less capital, amplifying potential profits, but also potential losses. Let's break down how trading futures actually works. Each futures contract specifies a delivery date, the date when the asset will be exchanged. Most futures traders, though, don't actually wait for delivery. Instead, they close their position before the contract expires by taking an opposite trade. This way, they never have to handle the physical asset, they're just trading the price. For example, if you bought a gold futures contract expecting prices to rise and the price does go up, you could sell the contract for a profit without ever owning actual gold. There are many types of futures contracts depending on what you want to trade. Some of the most popular categories include commodity futures like oil, gold and natural gas, financial futures like the S&P 500 index, and currency futures for foreign exchange. Each type offers unique opportunities and risks, so it's important to understand what market you're trading in. But here's the thing, while futures trading can be profitable, it's also risky. Leverage, while powerful, can work against you. A small change in price can lead to big losses if the market moves the other way. Also, because futures markets are highly volatile, prices can swing dramatically in short periods, and don't forget margin calls. If the market moves against your position and your account balance falls below the required margin, your broker may force you to deposit more funds or close your position, resulting in a loss. Now that we've covered the basics, let's talk about how to actually start trading futures. First, you'll need to choose a broker that offers futures trading. Make sure to check their fees, margin requirements, and platform features. Then, Open a trading account, deposit funds, and select which asset or market you want to trade. It's always a good idea to start small. You can trade mini or micro contracts to limit risk while you learn the ropes. Before we wrap up, here are a few key tips to keep in mind when trading futures. 1. Always manage your risk. Set stop losses and never risk more than you can afford to lose. 2. Keep learning. Markets change and so should your strategy. And 3. Stay disciplined. Futures can be emotional, but the best traders are the ones who stick to their plan. Remember, trading futures isn't about making a quick buck. It's about long-term strategy and understanding the markets. So there you have it, the essentials of futures contracts and trading. Ready to dive in? Start small, stay informed, and remember, success comes to those who plan. Don't forget to like, subscribe, and hit that notification bell if you found this helpful. See you next time with more trading tips and strategies.